So how many how many communities are you in, right?
Right now,
Mhm.
the legacy communities are three, two in Ondo State, one in Abuja. We've just secured financing for 20 more communities, which we started deploying right now. So we're in 20 more communities. So that's 23 communities. Work is ongoing right now. And we just started building the pipeline for our next 30,000 connections, which we plan to start deployment by Q4 2026. And that would be in 70 communities. So we're hoping by the end of this year, we should be in 70 plus 20 plus 3. So we should be in 93 communities by the end of the year.
I mean, that is so from 3 to 93. How many? 10,000x or at least 1,000x? So
I mean, if we don't install all of the 93, all of the
yeah,
70, this is where we're going to start, right? But for sure, by H1 2027, we should have been done
so
with
you
all the
you're
70.
building a basically integrated decentralized utility, more or less.
Yeah, yeah, sure.
Nice, nice. That is, I love that. And okay, I want to talk a little bit about your capital stack because I've always felt that one thing that a lot of businesses in the sector struggled with was or is the macroeconomic differences or discrepancies that could happen because you make usually all your bills are in, sorry, all your bills are in, your revenue is in Naira. And a
Hmm.
lot of times your bills are in dollars. You know, you're paying
Hmm.
Crow, you're paying all these other guys who want dollars for real and important reasons why they want that,
Hmm.
right?
Of course.
How do you, and so I've always felt that in this space, you need to be big. Like you don't have a choice. You need to be big, like just like physically. Your company needs to have turnovers that in and out easily every year, close to $1 million to $2 million. And in our context, that is big, or at least in the Nigerian context, that is big, right? How do you, well, and your capital stack needs to be designed in a way to be able to manage different kinds of asset classes, right? How do you manage that? Because you can't put all your equity into 93 communities, right? You have to raise some kind of debt structure to do it. And because we're in this space, there might be some aspect of blended financing. How do you manage that? How are you able to manage that team, the finance team? How are they thinking about scaling
Yeah.
from to 93? Because I'm assuming that you would have a very, not a complex, but at least a very diverse capital stack to be able to deploy, execute, and operate 90 communities within a span of 1 year.
Hmm. Yeah, great question. And you're speaking to the converted because we had suffered massively from taking obligations in hard currency. Suffered
Yeah.
massively. Still suffering actually because we're still paying back some of some of those obligations as we speak right now. And that was a lesson, that be careful in Nigeria to take long-term financing in hard currencies,
Mm.
especially when your revenue base is in local currency. So for us, we're purely infrastructure financing play. So we need to look at our business from how do you finance long-term infrastructure?
Yeah.
So that's kind of the premise of everything. And for us, we have a preference for considering local currency financing,
Mhm.
and that's exactly what we're using to scale at the moment. Local currency
Okay.
financing. Okay. But there is a play for foreign debts, right? Foreign debt. There's a play for foreign debt, especially because our immediate expansion is within the framework of the DARES program, right? And the DARES program, it provides USD grants, subsidies. So initially, with the current scale up we've done for 5,000 connections, we were not able to get our cost per connection to cover the entire capex cost, right? So we will still have an obligation in Naira that would last for at least 2 years post deployment that will still need to service from the revenue cash flows we get from operating the asset.
Mhm.
But the next scale up plan, our plan is to get that cost per connection down, that the subsidy would cover almost more or less 100% of the capex. And if we can get to that price point, then we can access foreign debt at very low interest rates, maybe sub 10%.
From your
And
balance sheet,
then
same.
so we'll access that from a funder in maybe in the US or in Europe,
Mhm.
right, for infrastructure, knowing that the grant that's going to be paid by the World Bank is in USD and would cover 100% of the debt. So there is no gap. So the money we take from the US at a very low interest rate would be taken out completely when the World Bank pays the grant.
Mm.
So that would
Okay.
be, if that economics checks out, that would be the only situation where we would consider foreign currency denominated loan. Otherwise, we're sticking to Naira debts.
Okay. So not trying to be crazy or anything, but you did mention that it's very difficult or nearly impossible to scale a business with subsidies. But looks like this is the strategy here a little bit, or no?
Yeah, no, absolutely. There is a subsidy
Yeah.
window right now.
Yeah.
Okay, it's going to be a bit silly of me not to take advantage of
Okay.
what's
Of
currently
what's
available.
happening? Yeah. Yeah. Yeah.
Yeah, we have to basically build the business. If we're going to build unleveraged subsidies to basically run a machine and have a very, very secure asset base that's maybe in a few years generating $30 million recurring revenue, right?
Yeah. Powerful.
That asset base, and if the subsidy goes away at that point, fine, right? We have an asset base that generates $30 million recurring revenue. We can leverage that asset base as collateral and attract competitive debt without the subsidy and scale more infrastructure projects,
Yeah.
right? So there is a window of opportunity right now. We need to leverage on this as much as we can, build a steady base, a steady cash flow base, and then on the basis of what we've accumulated, start to expand in a sustainable manner.